Welcome everyone, my name is Adam, Rusmin.
Hello.
Victor.
Hi everyone.
Thanks for joining us. Today we're going to talk about 5 financial mistakes that you can make that will trap you in debt. So I think when we talk about personal finance, a lot of times it's the straightforward answer is that I'm spending too much money, right?
Yep.
Yeah, you spend too much, more than you earn, that will basically get you into trouble. But this particular roundtable, we're not going to talk about that specifically because that's quite straightforward. We want to talk about specific scenarios or examples or decisions that you make that make you spend too much money, all right, that trap you in debt. So we're going to cover that, and there are 5 that we want to cover, and we want to go through that and make sure that you don't get into these things, basically.
Yep.
Right. So the first one is basically, we always talk about having emergency savings, like 3 to 6 months, or even 6 to 12 months, or emergency savings just in case. But what happens if you don't have the savings? So what's going to happen to you?
Yep. So I think the moment if something happened to you, right? I mean, life is really, I feel it's unpredictable, right? Sometimes you're hit by retrenchment. Sometimes you're hit by health issues, medical bills, and all this. And if your saving is not there, eventually you will have to, borrow money, right? To actually fund whatever thing that you need to do, right? And when you borrow money, the interest rate is actually quite high, I would say, right? I mean, simple interest about 1 point something, but effective interest is actually much 3 or 4%.
Yeah. So I've had a look at the website. So let's say, for example, you really have no savings, you get hit with something, you have to borrow the money from somewhere. If your family or friends are not going to help you out, and they have every reason not to lend you money if they don't feel comfortable with that. Then you have to go to an institution or a bank. And for personal loans, I tracked it as about 1.8%, but effective is about 3%.
Yeah. Always look at effective
interest rate. So actually, once you do that, you're in debt. And if you have no savings, you're probably in a situation where maybe it's going to be difficult for you to even pay off this new loan that's coming in as well.
Yep.
Yeah, so that's really dangerous.
And I think there are good reasons why sometimes I personally also don't loan to friends, especially those long lost friends. And then all of a sudden they appear and then come and like asking for money to help, and it's not a close friend in the past. So I think that's the reason sometimes you don't get that kind of loan, especially you out of nowhere you just ask people.
But you lend me money, right?
I'll lend you money. So he can use this video.
Yeah. And the other thing is sometimes you can still go to those banks. You can go to banks and reputable institutions for these kind of loans. But if your credit score is really bad and you have to go to licensed money lenders, the interest rates are crazy. So I want to have a look. The maximum they can actually charge you, and this is regulated by MES, but the maximum that licensed money lenders can charge you is 4% per month.
Oh, that's crazy.
That is nuts.
That's like 48% a year.
Yeah. That's
so
crazy.
I did a quick calculation based on 5,000. If you borrow just 5,000, I think in 2 years' time that amount ballooned up to more than 10,000.
Yeah.
Just that with that 48% year interest rate, right? So that's why actually loan sharks still cheaper.
No, I think loan sharks could be even more expensive.
Oh, really?
Because the licensed one's already at 4%. So you can't even get that one. Then you go to loan sharks, then they'll charge you even more. So like they'll pay you this one, then they take out the first installment straight away.
Okay. Yeah, maybe credit card is actually cheaper, right? So that would be like 25%.
Yeah, but you can't swap everything for credit cards.
True.
Yeah. So the thing is, if you don't have savings and you have to like go to like money lenders as a last resort, the interest rates can kill you. So that's why you do want to have emergency savings, so you don't get into situations where you have to borrow more at crazy interest rates, and that will trap you in even more debt.
So that's also the reason why we always emphasize, at least 6. I think 3 months is not enough. I think at least 6 months to 12 months, depending on your situation, right? If you have like very big loan or anything, right, then I think you should stretch higher.
Yeah. So I think if you are a civil servant, you have a very stable job, then obviously you can take a lower number, 3 months. Or someone who work in the healthcare, maybe 3 months is also very comfortable. But someone who's working in the shipping or cyclical sector, that typically will require at least a year.
You're self-employed,
Or self-employed, And you know that your business can be quite volatile from time to time. Then you might want to buffer a longer time frame for the emergency savings.
So if you see yourself as a company, right, your capital structure of 6 months, 12 months depends on your occupation. Right? If it's iron rice bowl, 6 months. Not iron rice bowl, 12 months.
So usually we talk about having savings so you can pay off whatever emergency. Then now we're going to cover the other side, is that if you don't have the savings, now you got to borrow. which is dangerous. All right, so that's number one. That's the first financial mistake. Second financial mistake is that sometimes people depend too much on their future income.
Yep.
So you spend before you actually make that money. So tell us more about that one.
So this one I know because I have met someone who so happened to face this situation.
Okay.
Right. The person basically runs a business, and because sometimes when the business was doing well, right, they got the money up front. He assumes that the business will go smoothly, so he start to spend the money off first, right, living a very high lifestyle, right. But eventually, sometimes along the line, the business got into some trouble, and he have to take his money and put back into the business again, right? So I think sometimes if you keep spending your future money, right, and don't buffer for unpredictable things, right, it's very dangerous, okay? Because I feel, right, you always have the mindset of there's always raining days, right? You have to buffer for that, right? So you should not spend more than what you earn, and that has always been my philosophy. Always spend below your means, right? Don't creep to lifestyle inflation, right? Don't spend advance money. Don't take any credit card money and spend, right? Which I've seen a lot of people doing that, right? They sort in there, they realize they didn't pay and the interest just keep rolling and all this.
So that will trap you in debt.
Yeah, I would actually consider buy now pay later as part of this category, right? Because buy now pay later, I think, gotten very popular since COVID. It allows people to kind of like buy high ticket items, or sometimes even the smaller ticket items, and then pay them in installment, like 3 months, 6 months, or even a year, right? And I personally use buy now pay later. I think it's a great features, but it can be very dangerous for someone who doesn't have that money and they still want to go ahead and buy the item. Okay, I use it primarily because they were giving out a lot of coupon or vouchers, we call it, right? So I just give example, right? My aunt actually asked me to buy an iPhone, but I think entry level 1,000, 1,002, and then the buy now pay later I think had like discount of like $80. I think that was a good deal, all right? And then I think I can make the decision whether I want to make it. I think pay down in like 6 months. That was the minimum, and then maximum is at 12 months. So I made that decision just to take the discount and then pay it down in 6 months. Okay, so if you are using this feature, you have to make sure that you can actually already afford this item that you are buying. Okay, so you cannot like I don't have the money now, I want this product and I just use this feature buy now pay later to just get that product. All right, so if you make that kind of decision, you know that this item is like, it could be a small ticket item, but if you add up many small ticket items, it become a big ticket item. I think because I read on stats that 80% of Gen Z people actually use buy now pay later. Okay, so it's a good product, right? If you use it, if you know what you're doing. But if you are using it too often and then you have to like paying the bill, become liable to like maybe Grab Pay later or Atomy, and all these are users that actually the platform they are providing all this, right? So you don't want to be trapped in that situation where you are spending your future money now by using this feature.
Same thing happens with credit cards, right? Like, I don't have my salary I spent my salary already, but I want to buy something, and then you use your credit card and you think, my next month's salary is going to cover that. And then that's a little bit dicey. But then if you keep doing that, it can really balloon and your credit card debt can go up.
That is a wrong mentality. You should never go into that.
Exactly.
You always spend whatever you have right now, and always below. Right? You don't spend to the brim. Right?
So I think all of us use credit card, right? But we use credit card and then we usually pay down within that 1 month.
100%.
Everything. No outstanding
always,
due.
I'm very on time. My credit rating very high. I go and buy myself. I go and check.
The only time that you have outstanding amount when you forget to pay the bill. Not because you want to, but because you forget.
You forget,
but nowadays, late penalty fee all can be waived, right?
I think this is a very important skill also. Learning how to manage the credit card.
And you get to earn miles, sometimes cashback also, depending on what you want.
So I just wanted to point out is the mentality of spending future income that can get you into this kind of situations, and then that just balloons your debt. So that's point number 2. This is the second financial mistake. The third financial mistake that I've seen, and this is really interesting because you can actually take 0% down car loans. I didn't know that until recently, or maybe quite recently. Because when you buy a car, typically if you buy your car for yourself, it's a 40% down payment. And then you can stretch it out to 7 years max. But recently, I also found out that if you have if you've gone to the PHV scheme, private hire vehicle scheme, you can actually go 0% down.
Wow!
So no money down, and you can stretch it out to 10 years.
That looks a lot more affordable.
It looks more affordable because you don't have someone who's saying, I don't actually have the money to buy a car, but now I can buy a car. Put it 0% down, I just make sure I can pay the monthly installments. And then I'll stretch it to 10 years so that my monthly installments comes down as much as possible. It looks cheap, but it's actually very expensive because car loans are straight line interest. The moment you do take the car loan, you're on the hook for the interest, even if you sell the car. And then if let's say you buy a car for 200,000 and you take a 10-year loan, and I think the car loans at, let's say 2.5%, for example. That's quite standard. 2.5% straight line for 10 years, that's 50K in interest straight up. Let's say the very next day you decide to sell the car for $200,000. You owe that bank or whatever, or that company. The bank's not going to give you that. That company 50K.
50K, yeah.
There's no way out of it. So the entire 10 years you owe that 50K and you got to pay it back.
Yeah.
So that is quite dangerous. Yeah, because what if you can't work?
Yep.
Let's say some people do that to do PHV. That's fine. But if you can't work and then you still owe that money to the company, that's interest that you just have to pay.
So this PHV scheme is actually mostly for those people who really want to go into the career, right? Become a private hire car, right?
Yeah.
So it seems like some people might have abused it.
Yeah, some may use that scheme, but don't intend to be private hire drivers. Which the point is that this thing is available out there, and if you're not careful with this, basically you're paying a lot in interest rate. Yeah, and
I feel if you don't have excess money,
don't buy a car.
Don't buy a car. Yeah. Buy a car only you have excess money. It's just like when you look at our friend AK, right? I mean, he's have a car going to close up to going to end of the COE.
Okay.
Yeah, and he's looking for a bigger car so that he can, send his parents. I mean, he on his YouTube he did say that he's frequent to the hospital because of his father checkup and all this, right? And he's going to buy a car now, and I asked him, so how many years loans are you going to take? He said, I'm not going to take loan. I'm going to pay it full. Yeah. I said, I think the car dealer don't like you.
Yeah.
Because they don't make much. They make a lot from the thing. He said,
they don't.
Yeah, I don't buy. I go to the next dealer. Yeah. I mean, last time when he bought this car, I remember he paid within 3 years. Right. Right now he got the luxury to do it because he have enough passive income. He's paying it full already. He don't want to go into any interest or something.
So if you feel that the car is too expensive to you, don't buy.
Yeah.
Right. So you only buy when you feel the car is nothing peanuts.
Yeah. No, it's just like it's like a part of your your annual income or your net worth. You can afford that. Yeah.
It's just a minor dent to your net worth.
It's a part of it.
I will say I will take it as looking at your net worth and see whether it's a dent or not.
But in reality, some people who really need a car, they still have to.
I get it. Yeah. But then you should make a financial decision where it's like, okay, I can take care of it. I'm not going to go over 0% down because that's just the interest rate is just crazy.
Unless you are doing sales.
Yeah, the car can be an asset in that way because you need the car.
Yeah.
But then still, it's like taking that kind of terms, 0% down, 10 years, is just financially
not savvy.
Very dicey actually.
Yeah.
So that can actually trap you in debt because the moment you jump onto that, even if you sell the car, you're in the negative straight away.
Yeah,
straight away. Okay. So that's point number 3. The fourth financial mistake is that you guarantee other people's loans. Yeah. Any stories about this?
Do not do that. I mean, my house has 3 rules my dad set: no gambling, no drugs, and no guarantor. Right.
So you can smoke.
Huh?
You can smoke.
Smoke. My dad smokes, so yeah.
That's why he didn't set the rule.
Yeah, I don't smoke. I'm allergic to the thing. Yeah. I think why my dad sets all these rules because he has seen how these people suffer after this, right? I mean, the third rule that was set, initially there's only 2 rules, right? The third rule was set because my dad suffered from it.
Okay.
Yeah, so my dad runs a business and he guaranteed for one of his friends that he thought was a very good friend. So in the end, the friend actually ran away and my dad have to take over the whole loan for him, right? And it was 7-figure.
Whoa.
Yeah.
A 7-figure.
So in the end, my dad had to go... that was in my early years when he was younger, so that he have to go bankrupt, right? So but throughout the years, my dad restart everything, and he already cleared everything. He's out of bankruptcy already.
But he was a guarantor for that loan.
Yes, correct. That's the someone that he thought was a good friend. So I think you should never guarantor for anyone, even your own siblings or something. Never do that, right? there's always other ways to get money, but never guarantor.
So Adam, I can lend you money, but I won't be your guarantor.
Just in case you don't know what is guarantor, is like when someone take up a loan, they need someone to guarantee that in case you can't pay up, the next person will pay up, right? So that was what happened to my dad. Yeah.
So basically, you're on the hook for the loan.
Yeah, correct.
Basically,
but lucky my dad is able to clear the whole thing.
Yeah. So this is something that even if you're like financially responsible yourself, but because you are loyal to your friend or your family member, and then they say, hey, I need you to be a guarantor, and then you end up trapped in this kind of debt, and it's not really your fault. You're trying to do a good thing.
Yeah.
But these things can happen.
Correct. I mean, my family does suffer that few years. Right. My dad paid back very fast, so maybe the 2-3 years.
Did the friend ever pay back your dad?
It's gone. Don't know where is he.
Okay.
Disappear.
Okay.
Yeah.
Oh no. Okay.
Yeah.
So real life stories.
Please do not do that. Right. It really hurts your family.
I mean, I also know people who also had to declare bankrupt because of the loan that the company took.
Okay.
And he is a guarantor for that loan.
Okay.
And when the business again turns sour,
but that's his own company. Is that what happened?
Or
someone else's
partnership. Yeah,
okay.
partnership. Yeah. So and then still working very hard to get out of that.
Okay.
Bankruptcy. Yeah.
Yeah. Okay. So these things can happen. Be careful.
Yep.
Okay. And the last one we're going to cover, the fifth one, is should you borrow to invest? So sometimes people talk about, hey, no, the S&P is growing 8-10% a year. Why don't I borrow at 3%? And I'll make the spread. What do you think about that?
I think you should never.
Yeah.
Especially for stocks.
Okay.
Right. Because the thing about stock is that it's a very volatile asset. Right. On a single day, right, a stock can drop like 20% or 50%. Right. Then you will get a margin call on that. Right. It's unlike properties, Properties, I mean, it do happens in the history, but very seldom. Like on a single day or something, it drops like more than 20%. You have to margin call on your properties and all this, right? So stock is generally more volatile assets. So loans is very good for less volatile assets like property.
Singapore
property. Singapore property.
Yeah. You took. I mean, that someone could be asking, why can I borrow for a mortgage but not for investing in the stock market? And the reason is because of these crazy swings.
Correct.
In the stock market.
Actually, if you go back to 2020, that also was the reason why the stock market dropped very fast during the 2020 pandemic. Initially it drops very quickly, then suddenly it escalates a lot because the moment when it dropped suddenly, I think 20% or something, right? I think at that point of time a lot of people took up margin. At that point of time the margin loan was high. Then it get a lot of the margin loan have to close the position, and that's why the market went down very fast on the next few days because of all these margin calls. Right. So never be in that situation. Yeah. Never in that.
Always happen in market meltdown so far. I think 2020 was one of those moments where you literally like hearing like bankers like liquidating some of their client position because they breached that margin loan.
And it's the worst time to sell.
It's the worst time to sell, right? And they had to because they need to protect that collateral, the bank. Yeah.
So if that happens to you personally, is this going to be extremely painful? Because like you think that you can borrow to like basically magnify your returns, but if it goes the other way, you basically magnify your losses.
So that's why I say is never listen to anyone to tell you to take margin loan to buy a stock. Never, because the moment the person say this, right, it means that the person is looking at returns instead of looking at the risk. When it comes to investing, right, it's all about looking at your downside and you compare with the reward that you can have. Then you see whether the risk and reward is down there or not, right? Yeah. If you always look at the upside, I never look. It's just like buying lottery. You are taking loan to buy lottery, and you're betting it whether you're strike. Don't do that.
Yeah. If you like personally use loans to invest in stock, I think you can kind of like tell that yourself. You keep a very close tab on the market news. Every good news or bad news, right? You always on the tab, and you can be quite stressful. Especially when there are times where there's a sell down, you have to quickly liquidate the position. If not, you might get into the situation of margin call. Yeah. So, if you're investing like that, that is not investing. Right?
And the thing is, like, someone could actually do it for themselves because they're, like you said, very savvy. They have the pulse on the market. They manage their risks very well, and they are able to take a bit of leverage to do those things. But if they were to tell you to do the same thing, it's a different thing altogether because
Yeah.
they don't know how you manage your risk,
Correct.
how you manage your emotions, and to give that sort of advice can be very irresponsible because it doesn't mean that he works for it. It works for himself.
Correct.
It can work for you.
Correct.
It's not advice that you want to take. I mean, I know some people who do take leverage,
Yeah.
but they could be extremely savvy
Yeah.
traders or investors.
Correct.
Yeah.
Yeah, I mean, you still can take loan, but not this type of loan. Like example, let's say you take a personal loan, the effective interest is 4%, but you pay monthly with your salary. So you are just taking upfront advance salary to buy into the stock. Only when you exhaust all your thing about the market is very cheap and you know what stock to buy, you buy a very stable stocks that generates the yield and all this. Then you can consider that. But like I said, it's not for everyone.
Yeah.
You have to be savvy to do that.
Yeah. Because even what you just said, that assumes that you know what stock to buy.
Yes, correct.
You assume that stock is cheap.
Yes.
And it's gonna
Yeah.
return to
Yeah.
its
You just
value.
borrow and you know that your salary is an iron rice bowl.
Yeah.
Then you just borrow
If
it.
you know if you don't know what you're doing, and someone take that kind of like suggestion,
Advice, yeah.
and they take a personal loan and they go in all
Yep.
into, I don't know, Tesla,
Yep.
Nvidia, whatever.
They might get wiped out.
They might get wiped
Correct.
out.
Yeah. You take the money and go into a stable asset that you know. But the important thing is you must know the asset.
Yeah.
Right. If you don't know, right, do not do that.
Yeah, follow-
And I can tell you, not everybody can do that.
Yeah. I wouldn't do it myself. I just
Definitely,
don't like
it works on some people,
Yeah.
but it don't works on everyone. Right.
So then borrowing to invest, basically, it can get you into more debt. It'll
Yep.
trap you into
Yeah.
more debt again. So sometimes
Yeah.
you do a margin call and you still owe the broker money.
Yeah. Correct.
And that happens.
Even if that stock that you're going to invest is like fantastic stock,
Yeah.
all right? If you borrow to invest, the stock may,
still can go down
still
further.
go down further.
Yeah.
But over long term, it may go up. But then in between, you get caught in the down cycle. You have to margin call, sell your position, and then you're out of the
Yeah.
game.
Correct.
There's
stock-
this famous saying or phrase, right? The market can remain irrational longer than you can stay
Correct.
liquid.
Yeah,
Something
yeah,
like that,
yeah,
right?
yeah. That was
So even
it,
though
yeah.
you're right, if you can't last the distance, you're out.
Yeah.
You're out of the game.
I mean,
Yeah.
you look at every listed company, right? The one that lasts the longest, right, without any financial issue is the one that have very good financial balance
The
sheet.
strong balance sheet.
Yeah.
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 It's not the one that have a lot of debts in it, right? So just treat yourself like a company. Look at your own capital structure. Make sure that your capital structure is a very conservative capital structure. Your job as an investor is to stay in the game. It's not one loan and wipe you out and you're out of the game already.
Yeah.
No, stay in the game.
Yeah.
That's the most important thing. So every time when you want to do certain thing, you ask yourself, if I were to do this action, am I still, in case I'm not right, am I still able to stay in the game? That's
Yeah.
the most important thing.
I think some people, there's a good metaphor. And the reason why some people think of, I think we want to say is that you want to finish the race.
Yep.
You don't necessarily have to finish first.
Yeah.
Because when you think about finishing first, I got to do all these other things to like make my 100-200%
Correct.
returns all the time. You don't have to do that.
Yep.
You just need to finish the race.
Yep.
Which is you have to enjoy your retirement
Yeah.
in
Correct.
luxury, however you defined it. So I think that's the point of investing.
Yep.
All right. So these are the 5 financial mistakes that we wanted to highlight, that these are specific scenarios that could
Yep.
happen to you that could trap you in debt. So even though you could some of these things, like maybe you're doing your things okay, but then you guarantee other people's loans.
Yep.
You end up in trouble. So just to summarize, the 5 financial mistakes. Number 1, you don't have any emergency savings, and then you get hit. Then you got to borrow money at high interest rates. That's not good. Number 2, depending too much on future income. So then you're spending your future money.
Yep.
Yeah. Number 3, taking 0% down car loans, which I think is very dicey. Number 4, again, guaranteeing other people's loans. And then number 5, borrowing to invest, because the stock market can be really
Volatile.
Right. So these are 5 financial mistakes you probably don't want to make. If not, they could trap you in debt. All right.
Yeah.
Anything else, guys?
That's all.
Yeah.
All right. So my name is Adam, Rosemary, and Victor.
Thank you.
Thanks for joining us. If you want to share your personal experiences with all these things, tell us more, and other people who read the comments can learn as well. Or maybe you have other mistakes that you want to share that say, hey, you can if you do this too, it's going to be really dangerous, and we can learn as well. All right. So put them in the comment section. We love to learn more. All right. So with that, did I say our names already?
Yep.
Yeah, Adam, Rosemary, Victor. Thanks for joining us. If you like the roundtable, please hit the like button, and of course subscribe to our channel. Many more roundtables coming up, and we'll see you again.